Welcome back to the Investing Talk podcast.
Today we're looking at United States Antimony.
As usual, before you start, subscribe, like, and comment to this video to support the show. Now, United States Antimony, ticker UAMY. I have to be honest with you right out of the gate here.
Go on.
Looking at the initial data on this one, my meme stock alarm bells started ringing. I mean, ringing so loud I couldn't hear myself think.
Oh, okay.
You've got a stock that is up over 400% in a single year. That usually screams hype train.
Right.
Or just retail madness. And when I dig into the financials, I see negative earnings, negative margins, a history of being a penny stock. So help me understand, is this just a massive momentum trade, or is there an actual, a fundamental business transformation happening here?
I completely get the skepticism. I do. If you were only looking at the trailing financials, just looking in the rearview mirror, you would walk away immediately. The numbers don't look pretty.
Right.
But with U.S. antimony, you have to zoom out and look at the geopolitical map first. This isn't really a mining stock anymore, not in the traditional sense. It's evolving into a critical defense play.
A defense play.
Exactly. You have to consider two massive game-changing factors that explain that 400% move. First, antimony prices have surged 500% in the last year. That is almost unheard of for a commodity.
500%. That's not inflation. That's a paradigm shift.
It is. And second, there's a specific sole source government contract that completely rewrites the investment thesis. We aren't just talking about digging rocks out of the ground. We're talking about securing the national security supply chain for the United States military.
Okay, let's unpack that. Because 500% commodity inflation is great, but only if you have the product to sell, right? And if you're losing money, high prices don't automatically fix a broken business. What is the actual path to making money here?
Well, it comes down to this massive inflection point that management is guiding for right now. They have put a target on the board that is turning a lot of heads on Wall Street.
And what's the target?
$125 million in revenue for 2026.
Hold on. $125 million. Just to ground this for everyone listening, what are they doing right now? Because looking at the Q3 2025 numbers, they did what, about $8.7 million?
Exactly. You're spotting the discrepancy. If you annualize that current run rate, you're looking at maybe $35 to $40 million for the year. So management is effectively telling the market they plan to triple their revenue in a single year.
That is an incredibly aggressive target.
Yeah.
That's the kind of hockey stick growth you see in tech, not mining. And they missed expectations in Q3 slightly. So why should we believe they can just flip a switch? Is this just optimism, or is there a real mechanism for this?
It's a fair question, but that Q3 miss is backward-looking. It reflects the cost of setting up the chessboard and not playing the game. The reason that $125 million target is credible comes down to their moat.
Their moat.
In this industry, a moat is permits and furnaces. And U.S. Antimony owns the only two permitted antimony smelters in North America.
Wait, the only two?
Yep.
In the entire continent?
The only two. One in Thompson Falls, Montana, the other in Madero, Mexico. And the context here is everything. In December 2024, China put an export ban on critical minerals, specifically antimony.
And they were the big player.
They were the OPEC of antimony. They controlled over 70% of the global supply. So when they turn off that tap, it created a massive supply vacuum in the West. If you need antimony, and the military needs a lot of it, you effectively have one phone number to call now.
That explains the strategic position. They're the only game in town, but being the only smelter only matters if you have, well, gas to put in the pumps. Do they actually have the rock?
That is the billion-dollar question. And the answer is in two key operational developments. First, the Montana connection. They recently acquired the Radersburg flotation facility for about $4.75 million and put another $2 million into upgrades.
Can you explain flotation facility simply? I'm assuming we aren't talking about pool toys here.
No. Definitely no pool toys. In mining, when you dig up rock, it's mostly just dirt. A flotation facility uses chemicals and air bubbles to separate the valuable mineral from the waste rock. The metal floats to the top. It's a critical step.
Okay, so that secures the middle of the supply chain.
It does. But you still need the raw ore to put into it. And that leads to the second and arguably bigger development, the Bolivia connection. They've signed an exclusive contract to get processed antimony flake from a facility in Bolivia. And this isn't some small operation. The facility there just finished a 15-fold expansion.
So is that hose actually flowing yet, or is this all just on paper?
You've hit on the key catalyst everyone is watching. The first 150-ton shipment is expected to arrive in February or March of 2026.
So next month or the month after?
Yes, that is the proof of concept. If that shipment arrives and gets processed, it validates the entire model.
Right, so we have the factories, facilities, and we potentially have the supply. But who's the buyer? You mentioned a sole source contract.
This is the Defense Logistics Agency contract, the DLA. It's an IDIQ indefinite delivery, indefinite quantity contract worth up to $245 million.
For those who don't speak government contracting, what does IDIQ actually mean for their bank account?
It's not a lump sum check. Think of it like a corporate credit card with a huge limit. The government has pre-approved them to spend that much, and they order it in chunks. But they did secure the first $10 million order back in September.
Okay, so the $245 million is the ceiling, not the guarantee.
Correct. But the fact that it exists sets a floor for their revenue. It validates the national security narrative. The Pentagon needs to replenish the strategic stockpile, and they cannot buy it from China anymore. It turns a speculative mining play into something more like a defense contractor.
Which provides a safety net. But what about financial health? I mentioned the losses. Are they going to run out of cash before this all comes together?
It doesn't look like it. Despite the negative earnings, which are from that heavy reinvestment, the balance sheet is surprisingly strong. Their current ratio is 5.1.
5.1, that's incredibly liquid.
Right. It means they have 5 times as many current assets as liabilities. And crucially, 0 long-term debt. They're pouring every cent of cash back into that Montana facility, and they're also seeking another $44 million in DOE funding.
So they have the cash to fund the growth. Okay, good. Let's pivot to the charts then and look at the price action. Because the story sounds great, but the chart looks like a roller coaster.
It absolutely is. I mean, we are looking at a stock that has risen about 415% over the last 12 months.
And just recently, in the week ending January 24th, it surged another 31%. Is that just news-driven?
That surge coincided perfectly with the news about the Montana acquisition. The market saw that as the missing piece and repriced the stock, well, instantly. It's hovering around $10.85 to $11.73 now, breaking out to new 52-week highs.
But with that kind of move, you get insane volatility, daily swings of 10%, 30%. The beta is 1.61.
Right. For the listener, a beta of 1 means it moves with the market. 1.61 means it's 61% more volatile. This is high octane. It's not a stock you buy and forget about.
It sounds like it has a lot of retail attention.
Retail enthusiasm is through the roof. On platforms like StockTwits, the sentiment is tagged extremely bullish. The whole stick it to China narrative really resonates.
Speaking of excitement, there's another data point here that just screams danger or opportunity, depending on your view. The short interest.
This is where it gets fascinating. Short interest is roughly 17.98%. That's about 24.4 million shares sold short.
That is very high. That's nearly a fifth of the float. Why are so many people betting against it?
Well, likely because of the valuation and the history of losses. Short sellers are looking at the negative EPS and betting the company can't execute. But the days to cover is around 2.65. What this creates is a classic powder keg scenario.
For a short squeeze.
A textbook short squeeze. If news drops about that Bolivia shipment arriving, those short sellers start losing money fast. They have to buy the stock back to close their position, but their buying drives the price up even further, forcing more shorts to cover. It's a feedback loop.
So you have a fundamental floor with the defense contract and a technical ceiling that might just blow off. Potent combination. How is the street reacting to all this?
The sentiment is strong, but there's a bit of a disconnect. Quantitatively, weighted sentiment is about 67% bullish. 6 out of 9 recent major articles are positive.
And the analyst?
H.C. Wainwright raised their target to $10.25, and William Blair rates it outperform.
Wait, $10.25. The stock is trading over $11. They've already blown past the target.
That's the disconnect. The consensus targets are lagging way behind the current price. It suggests analysts haven't fully priced in that 2026 guidance yet. They're being conservative. They want to see the revenue before they believe the story.
That makes sense. They wait for the numbers. What about the big funds?
Institutional ownership has risen to 24%. That's significant for a company this size. It shows smart money is starting to position itself, and management is showing confidence, too, by acquiring these facilities rather than diluting shareholders.
There's also some speculation about the political landscape, right? A new administration.
Yes, a lot of chatter about the new administration's focus on supply chain security. The idea is that the government might not just be a customer, but an investor to ensure these facilities stay open. It's speculative, but given the China ban, it's not unrealistic.
It adds another layer of potential upside. But look, it can't all be green candles. Let's look at the risks. What's the bear case here?
Absolutely, we have to. The biggest risk is just execution. We're talking about tripling revenue in 1 year.
Yeah.
That is a massive task. Everything hinges on that Montana facility ramping up perfectly and the Bolivia shipments arriving on time.
Right. Logistics are messy, a delay at the port, an issue with the ore grade,
Yeah.
mechanical hiccup.
Exactly. The stock is priced for perfection right now. If they miss that $125 million target, the stock could tumble. Failure is not priced in.
And the profitability issue. I mean, net margin is negative 15.49%. EPS is negative 4 cents. Investors are paying a massive premium for a company that is, right now, losing money.
That is the classic growth stock dilemma, though. You are paying for future earnings. But you're right, cash burn is a real risk if the revenue doesn't show up.
And risk number 3 is that valuation premium itself. It's trading at 180% above some fair value models. If that squeeze momentum breaks, or if antimony prices cool off, the drop from $11 could be steep. I'm looking at support way down at the 50-day moving average, which is around $6.56.
That's a 40–50% haircut from here. It's a very real possibility if the narrative breaks.
Okay, so we have the bull case monopoly, defense, growth. We have the bear case execution, risk, valuation. Let's boil this down. Final score.
When I weigh everything, the structural monopoly, the government backing, the revenue guidance against those execution risks, I give this a bullish score of 8.2 out of 10.
8.2, that's a strong score. So what's the investment thesis for someone thinking about this?
This is a structural monopoly thesis. You're buying the only U.S. game in town for a mineral the military absolutely needs. The $245 million DLA contract is the safety net. The 2026 revenue tripling is the growth engine.
I agree on the structure, but I would emphasize the time frame. This isn't a day trade. This feels like a 12 to 18-month hold to let that DLA contract ramp up and see if the facilities can actually print money.
Precisely. For price targets, my base case is $18 to $22. That's if they hit that $125 million revenue target.
And the bull case, if everything goes perfectly right.
If their own mining claims yield significant ore and margins expand to, say, 30%, you could see $25 plus.
A double from here.
Sure.
But to get there, we need to see that execution. So what is the one thing listeners should put on their calendar? The make or break event.
Watch specifically for the Bolivia shipment confirmation, February or March 2026. That is the next de-risking event. If that press release hits, it validates the whole supply chain. If it's delayed, be careful.
So the final verdict. While the valuation is rich, the geopolitical tailwinds are undeniable. You don't often get to invest in a company that the Pentagon is actively relying on to fix a national security hole. It's high risk, but the reward is very clearly defined.
Couldn't have said it better myself.
That's it for today's look at United States Antimony. Make sure to subscribe, like, and comment to this video to support the show. We'll see you in the next deep dive.